I'm speaking with Victor Mayer, Head of International Private Wealth at Pantheon. Victor, thank you for making the long trip from London out to Queenstown to join us at the Inside Network's Investment Leaders Forum.
Well, thank you. It's been a great day, and thank you very much for having us.
It's a great pleasure. Victor, how do you see the role of private equity evolving in modern private wealth portfolios, particularly as clients really attuned to seek differentiated return streams beyond the traditional?
Yeah, the first thing to recognize is that 90% or more of companies globally are private. And so if you want to fish where the fish is, you really have to spend some of your time kind of educating yourself and your clients into what is the private equity opportunity set. The second thing to note is that private equity is patient capital. So what does that mean? Those operators can buy companies and grow them over 5, 6, 7 years. And that tends to create what we like to think is a potential for premium versus public markets. And the third thing to note is private equity is an incredibly versatile playbook where you can, replace the management team, support the existing founding team, complete M&A, really kind of look for different ways to implement your process and your value creation to create repetitive returns and repetitive outcomes.
Mm-hmm. Pantheon has long benefited from global scale and really deep manager relationships. How do those advantages translate into better deal access and thus hopefully better portfolio outcomes for the private wealth investors?
Yeah. Well, the first thing to recognize is the private markets are incredibly large and complicated. And so at Pantheon, we've built a business creating what we think are the best fund managers globally. We do that in the US, obviously, with a US-centric deployment portfolio, but also in Europe and then in Asia. And with those managers, we always look for the best combinations of factors. And they tend to be sector specialists, regional specialists, and then segment specialists, growth, small cap, mid cap. And in that, what we find is a certain amount of comfort in terms of really partnering with best-in-class GPs who themselves have gone through cycles, bought companies, have scars on their back, and have sold a number of their companies as well. And so in that, we have a certain element of pattern recognition that we really think our clients value. Now, the magic in private equity is effectively being able to back those fund managers with primary capital, James, coming into those funds as they raise capital and, deploying with them, through cycles. The second part is being more transactional. And that's where having a secondary practice and being able to buy those fund managers on the secondary market, sometimes at discounts, really helps you kind of also generates good outcomes for clients. And third is the co-investment piece, where we can get into the companies one by one and handpick them with what we think is a much more granular amount of underwriting upfront.
Leverage is often a feature of private equity strategies. How should advisors assess the risks that leverage introduces? And how do you at Pantheon manage this across your own portfolios?
Well, leverage is a feature of the levered buyout industry. So the private equity industry is mostly composed of those LBOs, as people call them. The important pattern to recognize, or the characteristic of the market, is the higher you move in the market towards that large cap and mega cap exposure, the higher the leverage will be. And so in there, what we find is those bigger companies may be slightly more resilient in terms of their total size and scale and, kind of cycle resilience. But at the same time, the more leverage you use, the greater the balance sheet risk will be. I think for advisors and clients, it's important to recognize how much of that leverage risk you want and whether it's amplifying your returns or accentuating the downside risk. Now, at Pantheon, we specialize in what we like to call growth, small cap and mid cap investing, which is much further down in terms of company sizes. The one point to note there is those companies may be smaller and slightly more prone to idiosyncratic risk or, slightly less resilient. But if the leverage you use on those is lower, the balance sheet risk is more palatable. And so that creates in turn what we think is a very compelling or, a compelling environment for investors to lean into. The other part with leverage is it's directly linked to valuations. The more you pay for an asset in a leveraged buyout, the more leverage you need to make your returns work. And so I think investors should stay very focused on what it means to pay up and use more leverage. And that's typically a feature of large cap and mega cap investing. And that's something that we underwrite on every one of our investments as we put our money to work.
You've mentioned the mid-market as a place where the Pantheon traditionally has focused much of its activity. First of all, could you define that in terms of the parameters for our viewers? And then talk a little bit about what makes this segment really attractive for value creation and risk-adjusted returns.
Sure. So the mid-market at Pantheon, as we define it, and you're going to have a broad spectrum of definitions, James, in terms of how people think about it, is anywhere from 25 million US dollars of EBITDA to $150 million of EBITDA. And that would be the vast majority of the inventory of private equity-backed companies globally. Now, we like that space specifically for 5 reasons. And there's a lot of reasons, but the first one is the amount of assets or companies available in that specific segment is the greatest. It's about 85-90% of the inventory. So you effectively have a lot of potential candidates for acquisition. The second part is we find that in that particular segment, valuation risk is lower. So our fund managers, the fund managers we partner with, tend to have a very narrow focus on making sure they buy at the right price. Now, that also comes with lower leverage risk. As we've discussed in the past, it's very important to understand what the balance sheet risk will be with your acquisition. And we like that. Now, the fourth thing is really looking at the exit optionality. What we find there is that if you are buying smaller assets and helping them grow, you will be sitting in a position in the food chain of private equity where you can buy smaller and sell larger. And in there is a certain form of value creation that we really like at Pantheon, and that is arbitrage. The reality, James, is that the private equity industry has been, I think, dominated by a small number of large cap players who have been raising incredible amounts of capital over the last few years, and the theme of large cap getting larger. And what we find there is an incredibly sustainable exit environment where we can sell our businesses at what tends to be premiums to what we paid for them. And the final point, and that's the most important point, smaller assets can grow faster. Intuitively, you can guess if you buy a business that has $1 billion US dollar of earnings, getting it to $2 billion is going to be that much harder. If you buy a business that has 50, 60 million of earnings, you can look to sometimes double or even triple that across your holding period. And that tends to be the bedrock of what we like to call compounding at Pantheon.
Recently, secondaries have opened up a whole new avenue for private wealth firms to access private equity with a structure that gives them enhanced liquidity and pricing visibility, etc. Your team at Pantheon has considerable experience in the secondary space. What advice do you have for investors in terms of thinking about secondaries if they're new to that area but have read about it and want to get involved?
Yeah. Well, first of all, manager selection is the most important thing. The secondary market is an incredibly diverse marketplace where you can have, I think, globally more than 150 buyers. And so in that, what you find is different playbooks for value creation. That's the first one, is understanding who you're partnering with. The second one is understanding the use of leverage. I mean, a lot of secondary buyers, very much like their primary counterparts, are using leverage to generate returns. You've mentioned, James, the periodic liquidity and the semi-liquid funds and how these funds can offer a slightly better user experience to the wealth community globally and here in New Zealand as well. What you will find is that those funds can benefit greatly from a secondary investment playbook. The main reason for it is secondary buyers tend to buy assets 4 to 5 years after their primary acquisition. And so what that means for your remaining holding period is typically 2 to 3 years of expected future holding. And that brings liquidity forward for the investors. That liquidity, in turn, can serve 2 purposes. The first one is to protect the liquidity profile of the semi-liquid vehicle, the access point for the investors, and making sure they can redeem when they want to. And the second one is what we like to call recycling at Pantheon, whereby Pantheon can take some of those proceeds from the portfolios that we acquire on the secondary market and put it back to work. Now, as we've discussed in the past, the secondary market can oftentimes be a source of discounts. As you put the money to work, you can buy NAV at a discount to the face value. And that in turn, if you think about recycling, if you're selling that inventory of assets at a small premium, as I've explained, which is the feature of the mid-market, and then you put it back to work on the other side at a slight discount, there is a form of predictability of compounding that we find and our clients tend to find compelling.
So is the secondary space, does it allow a manager like Pantheon to be more opportunistic than it can be in the primary field?
Absolutely. I think there's an element of discipline as well. James, the reality of the secondary market is the amount of fundraising in the space has reached record levels, in 2025 in particular. And what you find there is the secondary industry is potentially exposed to what we like to call deployment pressure. And so when you talk about opportunities, I think it's important to differentiate for advisors the difference between pricing, so the discount, and value, the future earnings potential of the NAV you're buying. And in there, what we find at Pantheon is having access to that global curated buy list of primary funds, where we've built long-term relationships. We have access to their advisory committees. We attend their annual general meetings. We have the quarterly reports. We've co-invested with them. We've done secondary trades with them. That gives us a certain amount of data and knowledge, which is the opportunity. That's the edge. That's where you create the value and effectively stay disciplined in what is a pretty frothy market environment.
Fascinating stuff. And Victor Mayer from Pantheon, great pleasure having you here and chatting with you today.
Thank you so much, James, and thank you for having us.